So part 2. Sorry about the last video, I forgot it was 5-minute time, kinda ended abruptly. We were talking about expirations. Alright, so expirations will vary depending on the option. All options will expire on the third Friday of the month that the expiration month is. So, in the case with April, all contracts will expire that third Friday in April. With May, same thing. Open interest. Open interest is the total contracts that are traded on a particular option. This number will increase or decrease depending on if they're opened or if they're closed. So now that we're all on the same page, the two important Greeks of many, there are others, first are delta and gamma. So delta is a number between 0 and 1 that will vary depending on how the option will change according to the stock price. So let's take an example. This is the Bank of America options. I'm looking at the $14 call, and this has a delta of 96. So that means that when Bank of America goes to 1850, that this option will be 96 cents increased. So this will go from 365 to around 465. Now gamma is the rate at which this delta value I just talked about will increase or decrease. So looking back at that same example, this has a delta of, or a gamma of 0.04, which means that when this stock goes to that 1850 or whatever, that the delta is going to be equal to 1. So then it'll be every dollar that Bank of America goes up, this stock will go up 1. So what exactly do I do? Well, it's just like with the $1 to $4 stocks. I look for stocks that are breaking out or making new highs. Triangles, ascending triangles, just breakout patterns, channels, slanted resistances, anything like that. And when I find a stock, I want to make sure they have options, and when I've noticed that, I try to pick an option that has a delta close to 1, because I want the price of that option to change almost directly with the price of that stock. So in the case of Bank of America, where these at the money options are cheaper because they're only $90, because this is times 100, these have low deltas. So in this case, it's going to change $68 for each dollar. So what I would do is I'd probably go back another one and buy something more in the money with an $85 delta. That way I can make a little more for more of a point rise, although this will cost me $172 per contract, whereas this is $90. I don't pay much attention to that gamma. I don't know, that's just me personally. So just some examples. GE, bought some options on that a week ago or 2 weeks ago. Basically it had a resistance and it broke upon it and I got in. Win, didn't play it, but nonetheless watching that resistance. And lastly, MGM, this has a slanted resistance. It's actually more of a symmetric triangle if I would have drawn the support, but I think you get the point. So what I'm basically doing is I'm looking for stocks that are in desirable technical situations that are above $1 to $4, because I can't buy significant amounts of them, and I will trade options on them. Thank you for watching. This is Novice Trader.